Title: How Sam Walton Became the Rockefeller of Retail. The grit, strategy, and supply chain moves that turned small-town stores into a global empire. What began as a single discount store in a small Arkansas town hit a methodical plan to remake how America shops. How did one man make tiny margins work so well they crushed long-standing local shops and rewired supply chains across a nation? Introduction: Walton's audacious promise. Sam Walton's central bet was deceptively simple: sell more stuff at lower prices than competitors and use the resulting volume to build power. It sounded risky. Accepting razor-thin margins meant any inefficiency or supply disruption could sink the business. But Walton believed that if he could solve the hard problems, reliable supply, low operating costs, and predictable inventory flow, the math would reward him with scale, bargaining power, and profitable dominance. This section investigates how that strategy faced immediate obstacles, what patterns and data emerged as it unfolded, and the early signals that a different approach was needed. Part 1. Early problems Walton faced. Small scale and fragile economics. Low margin model. Walton's everyday low price promise meant per unit gross margin was intentionally tiny. At such margins, even small increases in cost, freight, shrinkage, labor could wipe out profits. Capital intensity of retail growth. Opening new stores required upfront capital for leasehold improvements, inventory, and staffing. For a small regional operator, financing expansion risked cash flow instability. Volume dependency. Profitability hinged on rapid turnover and scale. Without quickly achieving sufficient volume, the model was inherently fragile. Competitive landscape and consumer habits. Entrenched local merchants. In many towns, downtown general stores and regional chains had established customer relationships and credit arrangements. Price expectation and brand trust. Customers in small towns valued convenience and credit. Persuading them to change shopping patterns for lower prices required trust building and operational consistency. Fragmented supplier relationships and weak purchasing leverage. Small buyer problem. As a small chain in the early days, Walton lacked the bargaining leverage to demand lower wholesale prices, cooperative promotions, or favorable payment terms. Supplier risk and variability. Suppliers prioritized larger national chains. Smaller orders faced higher costs, longer lead times, and lower priority in allocations. Poor logistics and inventory practices. Distributed buying and replenishment. Without centralized purchasing and distribution, stores often ordered independently, causing uneven inventories, higher transportation costs, and stockouts/overstocks. Limited data systems. Manual records and delayed sales feedback made demand forecasting unreliable. Human resources and culture constraints. Finding disciplined, service-oriented staff willing to operate in lean, low-margin environments was challenging. Training and operational consistency across geographically dispersed stores were weak early on. Market perception and brand identity. Discounting can attract bargain hunters, but also stigmatize a store as cheap, making it harder to sell higher margin or specialty items without alienating customers or management focus. Part 2. Effects and statistics, early impacts and measurable outcomes. Note: specific historical figures vary by source. These points summarize commonly reported trends and outcomes from Walton's early decades. For formal use, cite primary sources, Walmart annual reports, SEC filings post-public listing, biographies, academic retail studies. Rapid store growth and national footprint. Expansion trajectory. From a handful of Walton's 5 and 10 stores and the first Walmart in 1962, Walton aggressively expanded through the 1960s. 1980s, Walmart became the largest U.S. retailer by sales in the 1980s, 1990s. Store count and sales growth. By the late 1980s, Walmart had thousands of stores and sales in the tens of billions, precise figures to be cited from company reports. Unit economics and margin dynamics. Low gross margins, high turnover. Walmart kept gross margins lower than many competitors, but compensated with high inventory velocity, fast sell-through of key SKUs, profitability through scale. Aggregate profit rose as sales volume scaled, enabling reinvestment in distribution and price cuts. Impact on local markets and competitors. Local business closures. Studies and reports show entry of Walmart correlated with declines in small independent retailers in many markets. Some empirical analyses find significant negative employment or revenue effects for local retail rivals. Consumer price effects. Walmart's entry typically reduced prices for many consumer goods in its markets, benefiting shoppers, especially price-sensitive households. Supply chain and operational metrics. Inventory turnover improvements. With better distribution and centralized buying, the solutions Walton pursued. Walmart achieved higher inventory turns relative to earlier periods and many peers. Distribution efficiencies. Centralized distribution and innovations like cross-docking reduced per-unit logistics costs materially after implementation. Financial and market dominance indicators. Purchasing leverage. As volume grew, Walmart secured better vendor pricing and terms, further lowering cost of goods sold (COGS). Market share. Walmart's share in key retail categories expanded rapidly, squeezing competitors and influencing supplier strategies nationwide. Part 3. Signs and symptoms of failing tactics. Early warning signals Walton observed. Operational red flags. Frequent stockouts of popular low-price items. Customers angered when loss leader items were unavailable, undermining the low-price promise. Overstocked slow sellers. Cash tied up in low-velocity items reduced liquidity needed for expansion or price competitiveness. Financial stress indicators. Cash flow pressure from inventory carry and new store openings. Rapid expansion without matching distribution efficiency strained working capital. Erosion of margins despite sales growth. Sales growth that didn't translate into improved profit suggested cost leakage. Supplier behavior and constraints. Suppliers resisting large price cuts for small volume orders. Walton's smaller purchasing footprint early on limited supplier incentives to cooperate. Inconsistent replenishment lead times. Unreliable fulfillment led to uneven shelf availability. Customer experience issues. Inconsistent store execution and customer service. Variation across stores in stock presentation, pricing accuracy, and employee helpfulness caused brand unreliability. Local customer backlash. Community resentment when small-town incumbents suffered losses or closures, creating PR and political headaches. Employee and managerial strain. High turnover and training gaps. Rapid hiring to staff new stores resulted in inconsistent operations and operational errors. Management bandwidth limits. Regional managers overwhelmed by rapid openings and daily issues, making oversight and standardization difficult. Strategic mismatch symptoms. Competing by price alone. Where Walton relied simply on discounting without systems, competitors could match short-term promotions, leading to price wars without long-term advantage. Lack of integrated logistics. Patchwork delivery and inventory management increased per-unit costs, eroding the intended benefit of low prices. Early diagnosis summary. Walton's early signs showed a consistent pattern. The promise of low prices drove customer traffic, but absent infrastructure and scale, the model exposed the chain to severe operational, financial, and competitive risks. The symptoms: stock issues, margin pressure, supplier friction, staff variability, and community backlash, made clear that the low-margin strategy needed complementary structural solutions to be sustainable. The problems and early signals above explain why Walton couldn't rely on price cuts alone. The next sections, part 2 of this two-part delivery, will trace the root causes in depth, review attempted failed fixes, and then detail the concrete solutions Walton implemented that worked, culminating in a step-by-step guide on how he executed a Rockefeller-style strategy in retail, supported by analogies and famous quotations. After that, I'll close with practical lessons learned you can apply to strategy and operations today. Would you like me to proceed with Part 2 now? Parts 4 to 7 plus lessons learned. Part 2. Roots, failed fixes, breakthroughs, implementation steps, and lessons. Introduction. What follows? This part completes the story. The root causes behind Walton's early troubles, the fixes that failed, the solutions that succeeded. A practical step-by-step of how he implemented the Rockefeller strategy in retail, and the distilled lessons. Read it as both history and a playbook for anyone pursuing scale-led, low-margin models. Part 4. Root causes, why the early problems persisted. Strategy, structure gap. Walton's strategy, lowest prices via volume, required an organizational structure, centralized purchasing, logistics, and data that he didn't initially have. The gap created recurring breakdowns between promise and delivery. Underinvestment timing problem. Early expansion consumed cash before distribution and information systems could be built. The timing mismatch, grow first, build systems later, created transient but painful inefficiencies. Misaligned incentives and immature processes. Store managers were rewarded mainly for sales, not inventory turns or shrink control. Without metrics and accountability tied to the low-margin model, behavior drifted toward convenience over efficiency. Market and supplier dynamics. Suppliers favored larger national buyers. Without demonstrable, predictable volume and standardized ordering, suppliers had little reason to give Walton better prices or priority. Incomplete information flows. Fragmented sales data and manual processes prevented rapid replenishment and demand forecasting, which increased stock volatility and hindered negotiating leverage. Cultural scaling friction. Walton's small store culture, entrepreneurial, improvisational, was hard to translate into disciplined, repeatable operations needed at scale. Part 5. Early fixes Walton tried that underperformed and why. Aggressive discounting without systems. Why it failed. Discounting increased demand variability. Without supply assurance, it led to stockouts and margin leakage. Rapid rollout of stores without centralized distribution. Why it failed. Decentralized ordering caused duplication, higher freight, and inconsistent customer experience. Localized promotion tactics and ad hoc supplier deals. Why it failed. Inconsistent promotions fragmented supplier support and made national supplier agreements difficult. Relying on conventional retail practices, renting big urban storefronts, copying competitors. Why it failed. Higher rents and urban competition undermined Walton's small-town cost advantage. Short-term finance solutions to cover working capital. Why it failed. Borrowing to cover inventory masked underlying unit cost problems without fixing operations. It increased financial risk. Part 6. Solutions that worked. What changed and why it worked. Centralized purchasing and aggregated demand. Action. Walton consolidated procurement for chains of stores, creating predictable, large orders. Why it worked. Suppliers responded to guaranteed volume with price concessions and cooperative promotions, directly lowering COGS. Investment in distribution centers and logistics. Action. Built regional distribution centers, optimized routing, and used cross-docking to move goods quickly. Why it worked. Reduced per-unit transportation and handling costs, improved fill rates, and allowed stores to carry less safety stock. Data, barcodes, and inventory management systems. Action. Implemented barcode scanning, computerized sales reporting, and later vendor-managed inventory programs. Why it worked. Real-time visibility enabled demand forecasting, reduced stockouts, and improved negotiating credibility with suppliers. Site selection and low-cost footprint. Action. Targeted small towns and strip locations with lower rents and labor costs. Standardized store formats. Why it worked. Lower fixed costs sustained low prices without sacrificing operating margin. Supplier partnerships and private labels. Action. Used long-term supplier relationships, volume commitments, and introduced private label items. Why it worked. Secured better prices, exclusive SKUs, and higher margin alternatives under store brands. Operational discipline and culture change. Action. Shifted incentives to metrics aligned with the model, turnover, shrink control, on-shelf availability. Trained staff on operational standards. Why it worked. Reinforced behaviors that protected thin margins and improved customer experience. Reinvestment loop. Action. Plowed early profits into logistics, technology, and more low-cost stores rather than luxury branding. Why it worked. Created compounding advantages. Lower costs funded lower prices, which increased volume and supplier leverage. Part 7. Step-by-step guide. How Walton implemented the Rockefeller strategy and won. Stage 1. Clarify the non-negotiable value proposition. Pick one promise. Lowest possible everyday prices. Publicly commit. Align marketing, operations, and leadership messaging around that promise. Stage 2. Validate market selection and economics. 3. Choose markets where incumbents are weak and operating costs are low. Small towns, underserved suburbs. 4. Run pilot stores to test price elasticity, SKU mix, and labor models. Measure inventory turns and contribution per square foot. Stage 3. Build procurement scale. 5. Consolidate purchasing across stores to create predictable volume pools. 6. Use volume commitments to negotiate lower vendor pricing, rebates, cooperative ad dollars, and extended payment terms. Stage 4. Create distribution backbone. 7. Design and build regional distribution centers positioned to minimize transport miles per store. 8. Implement cross-docking to minimize storage time and accelerate store replenishment. 9. Lock in logistics partners or build in-house trucking for reliability. Stage 5. Deploy information systems and metrics. 10. Implement barcode/scan systems and real-time sales reporting. 11. Roll out inventory and replenishment software. Measure daily SKU performance. 12. Align KPIs. Inventory turns, on-shelf availability, shrink percentage, contribution margin by SKU. Stage 6. Align store operations and culture. 13. Standardize store layouts and processes to reduce training time and variance. 14. Reconfigure incentives, reward metrics that preserve low costs, shrink control, fast replenishment conversion. 15. Train stores on loss prevention and customer service that supports repeat visits. Stage 7. Deepen supplier partnerships and margins. 16. Launch private label products to capture higher margin and control quality/pricing. 17. Negotiate vendor-managed inventory (VMI) or consignment for key suppliers to reduce working capital. 18. Share POS data with suppliers to improve forecasting and cooperative promotions. Stage 8. Scale prudently and reinvest. 19. Use profits to fund further logistics and system expansion, not short-term marketing. So cost advantage compounds. 20. Expand into adjacent markets only after distribution reach and buying power supported. Stage 9. Monitor externalities and manage reputation. 21. Preempt community backlash with community investments and transparent communication. 22. Monitor supplier dependency risks. Avoid overdependence on single vendors. Analogies and memorable quotes to illustrate the approach. Levy analogy. Building distribution and data infrastructure is like constructing a levee. Expensive and disruptive upfront, but once in place it channels the whole market flow in your favor. Engine analogy. Volume is the engine, logistics, data, and procurement are the pistons that make it run smoothly. Without pistons, an engine stalls. Quote Sam Walton, "There is only one boss, the customer, and he can fire everybody in the company from the chairman on down, simply by spending his money somewhere else." Emphasizes customer-centric price discipline. Quote Warren Buffett about scale, "Price is what you pay. Value is what you get." Underscores how Walton turned low prices into perceived value through reliability and convenience. Quote, anonymous paraphrase of Walton's ethic, work hard, be humble, and obsess over costs. Practical pitfalls and how Walton avoided them, tactical notes. Pitfall, growing faster than distribution can handle. Walton's fix, invest distribution early and phase openings by region. Pitfall, supplier squeeze or retaliation. Walton's fix, build a diverse supplier base and use predictable volume to obtain cooperation rather than coercion. Pitfall, culture diluted by scale. Walton's fix, maintain core values through training, recognition, and simple standardized procedures. Lessons learned, end of part 2. Strategy must be matched by structure and timing. A bold strategic promise, e.g., lowest prices, requires aligning organizational architecture, procurement, logistics, IT, and timing investments so capacity meets growth. Low margins can produce durable advantage if costs are controlled end-to-end. Volume alone is insufficient. Controlling COGS, logistics, shrink, and overhead is essential to convert volume into profit. Invest in infrastructure early, even if it temporarily slows visible expansion. Distribution centers, data systems, and supplier relationships are foundational assets. Early investment compounds into sustained advantage. Data and transparency unlock supplier collaboration. Sharing sales data and forecasts with vendors turns adversarial price battles into cooperative efficiency gains. Market selection amplifies strategy. Choosing initial markets where cost advantages are effective, lower rents, less competition, accelerates scale and credibility. Reinvestment and discipline create a virtuous cycle. Reinvesting savings into lower prices, better logistics, and more stores compounds bargaining power and brand trust. Culture and metrics matter. Align incentives and daily KPIs with strategic goals. Culture sustains execution when processes scale. Ethical/community considerations must be managed. Dominance has local consequences. Responsible communication, community investments, and stakeholder engagement mitigate backlash and build social license. Competitive advantages are systemic, not single point. Walton won not by a single tactic, but by creating an interlocking system, procurement scale, logistics, data, and culture that competitors found hard to replicate quickly. Closing, applying Walton's lessons today. Sam Walton's playbook is not limited to brick-and-mortar retail. It's a template for any business that seeks to win on low price through scale. The modern equivalents, cloud infrastructure for tech, centralized logistics in e-commerce, or platform aggregation, require the same alignment of strategy, structure, timing, and culture. Walton's genius was less in a single innovation than in orchestrating many moving parts into a durable system. As Jeff Bezos later put it about obsession with the customer and operational rigor. We're stubborn on vision. We're flexible on details. Walton was stubborn on price and flexible and methodical about every detail needed to keep it true.